Okay, so I've been having all kinds of trouble with this Zoom. It used to work so well, and now all of a sudden it's decided to really let me down here. Suddenly it refuses to access my camera. So I'm going to open up the notes, and I hope you can see everything. Hold on one second. Anyway, we're going to start the second week tonight, Intro to Derivatives, which is a bit of a deeper overview of everything we just did last week. Um, so Yeah, in fact, I was just on the line with technical support just until a few minutes ago. I was having trouble accessing the recordings, and it turned out something really stupid, some option that Norton offered me, which I said yes to, and that turned out to be a mistake, I suppose. Um, but this computer is very old, and I guess it's fallen apart, and it just literally I don't know what to do about it. I don't know enough about this stuff. So I guess the important thing is that you can see the screen, and that's all that really matters. So everybody can see the notes and can hear what I'm saying.
Yes.
Okay, good.
Yep.
That's what matters. So yeah, the camera not working is not going to be a problem then. It's just annoying, that's all. I'm just happy right now that the Zoom is even allowing me to record this. And also now I figure out the secret of how I can get it to let me find the recordings and then make them available on Brightspace. Just in case somebody misses something, you should be able to watch the videos anytime you please. But I've been having, like I said, all kinds of issues with Zoom. It's just completely out of nowhere. It used to be so reliable, and now it's becoming a real nuisance. But the important thing is that you can see what I'm doing, you can hear what I'm saying, and that it will actually record what we're doing. All right, that'll have to do for now. Anyway, so last week, we basically had a broad overview of derivatives. We looked at forwards, futures, options, and swaps very briefly. Now, going forward, we're going to take a deeper look at all of these different contracts. And of course, like I said last week, we're going to spend at least a few weeks looking at options in more detail because they're by far the most complicated of all the derivatives and the most interesting. And so they require a lot more study. But forwards and futures are very interesting and important as well as are swaps. It's just that they're just not quite so complicated. And so we'll look at these for a couple of weeks, and then we'll dive into option pricing and also hedging strategies, all kinds of interesting things, which will take us basically through the rest of the course until the very end when we're going to tie everything together with a discussion about risk management techniques. Because of course the whole point of derivatives is to hedge risk. That's why they exist in the first place. Certainly people can feel free to gamble with them, and many people do, but ultimately the goal or the purpose of derivatives is to hedge or reduce or eliminate risk. All right, so with all that being said, let's get started. So we're going to look tonight at the basic properties of forwards and futures. We're going to start to do a little math tonight. We're going to see how the forward price of an asset is determined, and that simply means the price at which an asset will be delivered through a forward contract. We're going to take a closer look at the marking to market process, where as we discussed last week, an exchange, a futures exchange, will require investors to put funds into what's called a margin account when they open up a futures position. And the purpose of the margin account is to basically act as collateral just in case the position deteriorates. The exchange does not want to be exposed to credit risk. In other words, if you lose a lot of money, they do not want to have to cover it. So what they're effectively doing is saying, listen, we'll trust you with 1 day's worth of losses. Okay, if you can't cover them, we'll close out your account. So the amount of money that they ask you to put in your margin account, as far as they're concerned, it's essentially an estimate of how much you realistically could lose in a single trading day. When the day is over, they'll calculate the value of your position, and if it has deteriorated sufficiently, you'll be asked to put more money into this account. And if you can't do it, then they just close out the account. That's the end of it. Also, we're going to start looking at some more theoretical results. A lot of what we're doing here is actually based on a lot of very complex mathematical ideas. And well, we'll see as we go along, but it turns out that futures and spot prices have to be equal on the maturity date of a futures contract. And otherwise, we'll see what happens. We'll also see how futures and forward prices can be different from each other. And also we'll start to understand how to hedge risk with futures contracts, and by extension, forward contracts. All right, so as we've already started to really look at some of these concepts, a forward contract, as you recall, is an agreement. That's all it is, to buy or sell an asset at a specific date in the future, but where the price is agreed on today. And it's that part that makes it such a powerful hedging instrument, because you can say, listen, I want to take delivery or make delivery of some asset or other like gold in the future, but I don't want to do that today. So what I'd like to do is lock in the price now at which I can undertake this transaction. And so that's what this contract is letting us do. But the interesting part is at what price you'll be allowed to buy or sell this asset. Okay, that price is known as the forward price. Okay, so we need to make a distinction here between what are called spot prices, which are prices for immediate delivery of an asset, and forward prices, which refer to the price at which we will take or make future deliveries. Now, it used to be possible to find this on the internet. The Wall Street Journal used to publish both spot and forward exchange rates for currencies. I don't think they do that anymore. I'm not sure why. Let's see what we can find. Wall Street Journal, forward exchange rates. Let's see if they still have this out there somewhere. Oh, well, okay. No, no, I don't think that's what we wanted. Let's see. All right, what do we have here? I'm not sure what that's supposed to be. No, that's not exactly what I wanted. These are the spot exchange rates. For example, you can see that as of today, each euro costs $1.0722. These are all spot exchange rates. These are for people who want to buy for immediate delivery. So if I want to buy, for example, it'll take 132.43 yen to buy a single US dollar. So I'm not seeing any forward exchange rates. They used to list them here. I don't know what's going on here. And they would typically be for maturity dates of 1 month, 3 months, and 6 months. And so you get all these quotes that told you how much it would cost if you wanted to buy, for example, British pounds in 1, 3, or 6 months, because those are the most popular maturity dates. I'm not sure why they stopped giving out these quotes, but what we'll see is that we can calculate them for ourselves. All right, well, let's see what they've got here. Okay, see, and again, this is wonderful as far as it goes, but these are all spot exchange rates. If you notice, what's interesting here is that they're giving us both quotes. For example, let's go to and find the British pound. There it is, UK pound. So in other words, if you see on the far left, 121.41, that means it takes $1.21.41 to buy a British pound, which translates on the right-hand side over here to 0.8237 pounds per dollar. Okay, so they're giving you both methods for expressing this exchange rate. Because the one you will want to use depends on what country you're in. For Americans, it would be more convenient if the price is so many dollars per unit of the foreign currency. But in Britain, it would be the other way around. So the British would prefer the quote over here on the right, 82.37. In the United States, it would make more sense for the quote to be 121.41. But what's missing here, I guess we're not going to find it, is the quotes for future delivery, 1, 3, and 6 months in the future, typically. But we're going to see how those are calculated anyway. So that means, in other words, we can do this ourselves. So And of course, we've already seen that forward contracts are completely flexible. We can write them on literally any asset we can imagine. They can be stocks, bonds, gold, currencies, you name it. As long as we can find somebody who can take the other side of our contract, we're good. All right. You also might recall we discussed how with futures contracts, there's only a handful of different types of contracts that are available. And so you basically have to take what they have. You cannot customize a futures contract. In fact, let's go look at the CME for a second, Chicago Mercantile Exchange. Let's see if they've got quotes here, or even just the terms and conditions. Oh God, what happened there? All right, I don't know what happened there. That's not what I asked for. Oh, I know what the problem is. It's Bing. I'm using this wretched Microsoft Edge thing, and the problem is that the default search engine is Bing, and I find that Bing is absolutely terrible. I just can't stand it. It's the worst ever. So if I want to search for something serious, I'm going to use Google. Bing just is terrible. It just is. It never gives me what I want. Like right there, it was a perfect example. It's giving me a bunch of crap I didn't even ask for, and here I'm going right to it. All right, here we go. So this is the British pound. Let's see, where are we? Quotes. Let's look at quotes. Okay, these are British pound futures quotes. Now, what I want you to notice here is that there are contracts available for February, March, April, May, June, July, et cetera, once a month. The problem is, though, that only the March contract has any open interest in it. So in other words, if I want to buy British pounds for future delivery, I can take the March contract, or God, look what else is available. I don't understand why there's so few, but the bottom line is there's only a handful of contracts to choose from. So it's not very flexible at all. And so that is a real problem for futures contracts. You know, if you need to customize your hedging strategy, it's not going to happen with a futures contract. By the way, why is that? Because the exchange makes its money from volume. Okay, so in other words, in order for them to have a huge trading volume for any given contract, you can't they're not going to be able to have a bunch of different contracts available. They'll basically have to steer the customers towards a handful of choices so that the trading activity is very large in each of those existing contracts. If they try to offer too many contracts, the volume will be very small in each one, and then they won't make any money. So they really don't have the ability to offer a very large number of contracts. Whereas with forward contracts, you can literally negotiate anything you want. So anyway, so the price now, by the way, if you notice, in some cases, I've already put in some handwritten notes here. That is the expression of the relationship between a spot and a forward price, only though for assets that do not provide any income to the owner. Okay, for example, gold. If you own an ounce of gold, it does not generate any income. If you own a British pound, on the other hand, you can actually put it in a British pound bank account and earn the British rate of interest. Now, you might not think that's possible, but in this day and age, you certainly can, if you have the right account or the right bank. You can certainly keep different currencies in different markets. You could theoretically, for example, hold a British pound bank account and a Japanese yen bank account, et cetera, et cetera. But whatever currency you're holding, you're going to earn that country's rate of interest. Here, though, in the simplest case where this asset has no cash flows to the owner, the relationship is actually surprisingly simple. Now, before we go any further, I just want to point out that this E is a constant, which is approximately equal to 2.71828, and it goes on and on forever. You may have run into that before in one of your classes, let's say in college or whatever. You see this used all the time when we're calculating present and future values of sums, but only under certain conditions. So let me just quickly do a little detour here. Just to quickly review what this is all about. So the present value of a sum is the amount that would need to be invested today in order to be worth that sum in the future. Okay, just as a quick example, for example, if a bank pays a 5% rate of interest, and just to keep it simple, let's assume that it's compounded once a year. Then, in order to have $1,000 in this account in 2 years, an investor must deposit. And then how much would they have to put in the bank today? Well, that would be 1,000 divided by 1 plus the rate of interest. And the exponent would be 2 because it's 2 years in the future. Okay, hold on. All right. Yeah, PowerPoint is very awkward with superscripts. Let me just fix that. Okay, so if you put that into a calculator, you'll get, rounding to dollars and cents, 1,000 divided by 1.05 squared is 907.03. Okay, so what this means is that 907.03 is the present value of $1,000 received in 2 years. Assuming that the rate of interest is 5% and that interest is only paid once a year. Okay, so and then we can turn this around and say that 1,000 is the future value of 907.03 invested for 2 years at 5% per year. Actually, let me sneak that in here. Okay, so present future value. The present value means how much do I have to save now to have a certain amount of money in the future. The future value is basically telling me how much I'll have in the future if I invest a certain amount today. So this is a very simple example because we're assuming that the interest rate 5% is only compounded, as it's called, once a year. In practice, it's much more complicated than this. Okay. So in other words, imagine now the same bank says, all right, everyone, we're going to change the way that we pay interest. Going forward, what we're going to do here we go. Going forward, we're going to change our policy to something slightly different. Suppose, for example, all right, here we go. Suppose instead that the bank compounds interest quarterly. Now, what does that mean? In other words, instead of paying 5% once a year, it pays 1.25% 4 times per year. Okay, so what is the future value, the present value of $1,000 to be received in 2 years? Okay, so here's what we're going to do differently. Oh, hold on, what happened? Well, we have to obviously change the way we do our calculations to reflect the fact that we're getting 4 payments a year of a 1.25% rather than 5% once a year. So what would be different is that let's go do the calculations again. And what you'll see is this time, instead of 5% once a year, it's 1.25% 4 times a year. So what this means is that in the denominator, instead of 1.05, I'll have 1.0125, which is 1.25%. And instead of 2 years, I have 8 quarters here. Okay, so this is going to change the present value. Let's see what that turns into. All right, so if you get out your calculator, you'll see that what we have here is instead only 905.40. Okay, now the reason why it's a smaller amount is because we earn more interest this way. So 905.40 is the present value of 1,000 received in 2 years when the rate is 5%. Compound, now we have to specify that it's 5% compounded quarterly. 1,000 is the future value of 905.40 invested for 2 years at 5% per year, compounded quarterly. Now, if I keep increasing the frequency of the compounding, you'll notice that the present value will keep dropping because I'm going to earn more interest that way. In fact, if I'm the investor, I want the interest to be compounded as often as possible because I will earn the most interest. If I'm borrowing, though, then it's the other way around. If I'm borrowing, I want this to happen as infrequently as possible. Now, in practice, in the United States, banks at least typically compound their interest on a daily basis. Now, if I continue to increase the compounding frequency, there's a limit to how far I can push this. Okay, in other words, there comes a point where I can't earn any more interest. So if interest, the compounding frequency increases until the number of compounding periods per year reaches infinity, then we are engaging in what's called continuous compounding. Okay, continuous compounding, it's as if interest is being credited to our account at every instant in time. Okay, so how would we then calculate our present and future value? We can't use the formula I just showed you because we would need an exponent of infinity. Okay, so instead we use something different. All right, let me just show you it to you really fast. So to compute the present value with continuous compounding, we use the formula. So the present value equals the current value, the sum that we're investing, which is the future value, and then we'll multiply that by E raised to the minus RT power. All right, and that's supposed to be an exponent, by the way. All right, hold on, let me turn that into an exponent. Okay, so in other words, PV is present value, FV is future value, and so R is the rate of interest compounded continuously. and T is time. Okay, so just as a quick example, let's go back and revisit that last example, and let's just say that instead of the bank paying us 5% per year compounded either annually or quarterly, instead it's compounded continuously. Okay, so how would that change our results? Now you might think we're going to earn an enormous amount of interest. Okay, so returning to the last example, if the bank pays 5% on a continuously compounded basis, then the present value would be, okay, we'll have 1,000 e to the minus 0.05 2 years. Okay, so again, this is all meant to be a superscript or exponent. Let me fix that. And so if you take out your calculator, you'll see there is a button on there somewhere labeled e to the x. All right, hold on one second. So you're going to have 1,000 times 0. Let's say 904837. So when you multiply that by 1,000, your present value will be 904.84, rounding to dollars and cents. Okay, so this is the limiting case to how low the present value can go. In other words, it can't go any lower than this because interest is being compounded on a continuous basis. And so what this is saying is that when rates are compounded continuously, instead of using the traditional formula for calculating present value, we have to replace it with this formula. And then we also note that the future value is just the inverse of this. Notice if I want to know what a sum will be worth in the future, I calculate the future value. And then it would be, we simply reverse this. Okay, we algebraically rearrange this, and we end up with so I'm going to reverse these two. If you rearrange this algebraically, you'll see the future value equals the present value times e raised to the positive RT power. Okay, so that's what this is going to tell me is if I start with PV dollars now, how much will I have in the future when interest rates are compounded continuously? So why did I go through all of this? What was the point? Because if you go back and look at this formula for calculating the forward price of an asset, well, you'll notice something very interesting. And that is that the forward price of the asset is nothing but the future value of the spot price. Okay, that's what this is all about. The spot price, by multiplying it by e to the RT power, what I'm doing is calculating its future value. Okay, so if I put S dollars in the bank right now, and they pay R, the rate of interest R, continuously compounded for T years, I will end up with F in my bank account in the future. So the forward price is just the future value of the spot price. Now, the logic behind this is that in order to acquire this asset at some point in the future at a guaranteed price, what I can actually do is borrow the money now, buy it and store it, and then repay the loan in the future. And the amount of money that I would repay in the future is exactly equal to this forward price. Okay, so there's all you're seeing here is the cost of repaying the loan, which is taken out today to buy this asset now and lock in the price. So that's what this mysterious formula is basically saying, that in order to lock in the price of this asset now, what I'm effectively doing is the same thing as if I borrowed the money now, buy the spot asset and store it and repay the loan at time T. Okay, so now with all that being said, all you have to remember is right what you're seeing here. Just remember that when there's no cash income coming to the owner, this is how you figure out the forward price. But just be aware that the reason why this is the forward price is because it's basically an alternative to acquiring the asset by, again, borrowing the money now, buying the asset now, storing it away, and then repaying the loan in the future. So that is the basic reasoning behind this formula. All right, now, of course, if the asset provides some cash flows to the owner, like I was saying before, the British pound, then we have to modify this formula. Okay, so how does that work? Let's see. I don't know why it keeps going to this stupid designer thing. Very annoying. All right, so, and again, Jesus. Okay. So actually, I'm going to save this. What I'm doing here is basically adding a bunch of new stuff to the notes. I'll save these and I can post these and on Brightspace and make them available to you, so we don't lose any of this. All right. What about cases where, oh, I see. You know what I didn't realize? I have some examples in here too, which show how future values are affected by compounding frequency. And you can read those when you get a chance. So I think we're already all set here. Yeah, what this chart is telling us is that if you keep increasing the compounding frequency, the future value will grow, but fairly slowly. First, it rises very quickly, and then it levels off, and eventually it reaches that limiting case, which is continuous compounding. All right, so here, let's just do a quick example so you can see what's going on. Gold is selling for $1,500 an ounce. That's the spot price. The risk-free rate is 6% per year, and the contract matures in 6 months, which means that T is 1/2 of a year. What is the implied 6-month forward price of the gold in this contract? In other words, what should the price, quote, be for somebody who wants to buy gold for delivery in 6 months? So when you plug in these numbers, you can see that the spot price of gold is $1,500 a month. An ounce. The annual rate of interest is 6%, although it's only a 6-month investment. So if you plug in those numbers, you'll see that is equal to 1545.68. So if I want to lock in the price of delivery in 6 months, then I'm going to have to pay 1545.68. But just be aware that if I didn't have this contract, I would have had to borrow the money to buy the gold now, and this is how much it would have cost me to pay the loan. So the cost will be the same whether I use the contract or not. All right, that's the key. It's the same thing, as the bottom line is you end up acquiring the gold, and the cost is right there. Any way you look at it, the cost is always going to be 1545.68, whether I use a forward contract or I simply borrow the money now, buy the asset now, and then repay the loan later. All right, now here's another example where I've got a 3-month forward contract is written on a stock that pays no dividends. The stock is currently selling for $90 a share. Their 3-month rate of interest is 5% compounded continuously. So what's important here is that if you look at that formula, the T is listed as 0.25 because 3 months is being treated as a quarter of a year. Now, in practice, it's not quite as neat as that, but we're going to keep it as simple as we can. Let's just treat 90 days as being exactly a quarter of a year. And so the 5% is 0.05 in the exponent. The 0.25 represents 3 months. So this means that to take delivery of the stock in 3 months, I will have to pay 91.13. And so you can see we just plugged it in. And remember too, this is nothing but the future value of the spot price. Or think of it as, again, as the cost of financing this position in the spot market. Okay, now what about cases where the asset does provide income to the owner? Now, what that does is it makes the forward contract less attractive as a hedging instrument, because if you use the forward contract, you're not going to collect any income from the asset. That means we have to make an adjustment. Now, there's two ways that income can be paid from an asset. Number one, it could come in a lump sum on, inconsistently. For example, a coupon-bearing bond will typically make payments twice a year. So every 6 months or so, you'll get a coupon from the issuer. And so the formula here, as you can see, suddenly has this I term in here that wasn't there before. I represents the present value of the bond's coupon payments. Now, if you notice, we're subtracting it. In other words, we're lowering the forward price of this bond by I dollars. And why is that? Because the owner of this future forward contract, rather, gives up the opportunity to earn these interest payments. And so that reduces the attractiveness of the forward contract. And therefore, the value is going to be less than it otherwise would be. All right, so I think we have an example here of this. Here we go. So a treasury bond will mature in 15 months. It pays a 5% coupon on an annual basis. The next coupon is due in 3 months. I've drawn a little picture on the bottom here, by the way, so you can keep track of all these details. The bond's face value is $1,000, which means that when it's first issued, it costs $1,000. And on the maturity date, the owner of the bond receives $1,000. In the meantime, the owner, whoever it is, collects the annual coupon of $50 or 5%. At the moment, the bond is selling for $10.20 in the marketplace. Now, we're also told in the next slide that the 3-month rate of interest is 2.5%, and the 6-month rate of interest is 3%. Now, if you notice, we're allowing the rate of interest to be different for different maturities, which is normal. In practice, interest rates tend to depend on the maturity that they cover. In fact, if you want to see an example of this, we can go to the Treasury market. First, let's not do Bing because it's terrible. Okay, here we go. Now, this is the US government. Their Treasury Department has this page set up so you can look at the different yields from Treasury securities of different maturity dates. So let's just look at the top. All right. As of February the 1st, you can see that a 1-month Treasury bill has a yield of 4.59%, which surprisingly enough is actually higher than the longer term bonds. The 30-year bond is at 3.55. Now, by the way, just as a hint here, usually the yields are higher for the longer maturity bonds. When we see this kind of thing, it usually means that there's something not good happening in the market. Often this is interpreted as a sign that we're either going to have a lot of inflation in the future, or else we're heading right into a recession, or some of both. So these curves are actually saying to the markets that people are very pessimistic about the future. But the important thing is that each one is different. In other words, the return that you're getting depends on what maturity is the security that you own. No, I think this would be a sign that, actually, no, you're right. This could be that inflation may be lower in the future because the Fed has been so aggressive about raising rates that people are willing to hold a 30-year bond at 3.55% because they don't expect inflation to stay as high as it has. But at the moment, inflation is still very high, so that the Treasury bills at the short end of the curve are still yielding very high rates. But throughout US history, mostly you see the pattern is the opposite. The short-term curve is rates are very low compared to the long-term rates. In fact, we could go back last year and see what was more normal back then. Yeah, this is more like it. Look at last January of 2022. This is before the Fed started going nuts raising rates. Look how low the yields were on 1 and 2 month and 3 month treasury bills. And they would slowly go up, and it took all the way up to roughly 20 to 30 years before you actually got 2%. Historically, this is what we normally expect to see with these treasury yields. Okay, having the short-term rates be higher than the long-term rates is very unusual. And in the past, whenever this has happened, it meant things were going very badly. It meant usually people are pessimistic, although it may be that inflation is heading down. What's important here, though, is that, and we will discuss later on in the course, but let me just mention that the yields of longer maturity bonds are more volatile than the yields of shorter maturity bonds, because with a, let's say, a 30-year treasury bond, there are more cash flows that you're supposed to receive. And so if market conditions change, it's going to have a huge impact on the value of all those future cash flows, compared to, let's say, a 1-year treasury bill where there aren't really that many cash flows left. So no matter what's going on in the market, the longer term bonds have more volatile yields, which means that their prices are more volatile. And therefore riskier. So for that reason alone, the longer term bonds are actually considered to be more risky than the shorter term bonds, just because the prices can fluctuate more with the longer maturity bonds than the shorter maturity bonds. Now, we will see later on how to measure this type of risk. But again, because a longer maturity bond has more cash flows that are owed to the owner of the bond, anything that changes in the market will tend to have a bigger impact on the longer term bonds than the shorter term bonds. Because the reality is nobody knows what's going to happen in 30 years, but we have a pretty clear idea of what might be going on next year. So the longer term bonds are considered to be riskier. And so normally, and when I say normally, I mean except for this year, that's why the 30-year treasury bond here has a higher yield than, let's say, the 1-year treasury bill, because the 30-year bond is considered to be riskier. So now, when we see the opposite, that means inflation either is coming down from unusually high levels, or else the economy is really heading into trouble, or some combination of both. Okay, so this is very unusual in US history. If you go back, let's say 100 years, 90% of the time you'd see that these yields are increasing with maturity rather than decreasing. This is very, very unusual. But anyway, but the point of all this is that here we have a more normal scenario where the 3-month rate is 2.5%, and the yes, go ahead, Felicitas.
I just don't understand how you calculated the 2.5%. Like,
that was given in the problem. It's on the next page.
Okay.
It's down here somewhere. It hasn't. See, I drew this little picture on that slide, but the actual data is here.
Oh, okay. Thank you.
Yeah, these are just given to us. Okay, so we're assuming continuously compounded rates. Now, this is one thing I want to mention about John Hull's book. He loves continuously compounded rates of interest. In practice, these would not be continuously compounded, because the cash flows only take place, let's say, twice a year, depending on their maturity. So that's a bit of a reach as far as an assumption is concerned. But in practice, we can use any assumptions we like. We can convert any convention into another convention. So if John Hull wants to use continuously compounded rates, that's okay. We can easily figure out the equivalent rates that are not continuously compounded. So assuming that this is what we have, a 3-month rate, which is 2.5%, and it's again down here, the 6-month rate is 3%. So you can see, I guess I don't know if I drew that as well as I could have. I'm not seeing the 6 months here. Hold on a second. Yeah,
Can I ask a question real quick?
Yeah,
And I'm sorry, I didn't mute it. I just realized that now. Are you talking about the yield? Or because it seems like wouldn't the rate be what the coupon is of 5%?
no. This is the yield to maturity. The coupon is a fixed amount of cash that you'll receive on a regular basis. The yield is essentially the rate of return, which takes into account the cash flows from the bond, but also the price that you pay for it. So the yield, you can think of it as roughly the rate of return from holding that bond, but the coupon is a dollar amount that you're being paid. So now, if you are buying a bond at the par value or face value, the yield and the coupon rate will be the same. But if you pay a different price for your bond than the face value of $1,000, that means that
Right.
the actual return will be different.
Yeah, I know you just take the coupon payment divided by the price of the bond to get the yield. I understand that. But I know you said in the problem it was given about the 2.5% and 3%,
Yeah.
but I still don't comprehend how that can occur if you have a 5% coupon.
Oh, no, you know why? Because that means this bond could have been issued at any time in the past. In other words, we only know that it will mature in 15 months. So in other words, it could have been a 30-year treasury bond that was issued almost 30 years ago, or it could be a 2-year treasury note that was issued 9 months ago. So in other words, we don't know what its original maturity was. So the coupon was locked in when the bond was first issued, and that could have been at any time in the last 30 years. So that's why the coupon rate can be very different from the current market rates of interest.
Oh, I
So-
see. You're talking about like how the bond gets reinvested at the current market rate. Is that what you're referring to?
No, actually, I'll tell you what, let me show you something interesting here. There's a website which you can go to, and all right, let me take a detour here, a real quick detour, because I can see that we need to review a couple of key terms here. I'll start a new slide here for this. Or you know what, even better yet, the slides are so annoying. I'll just put this in a Word document. And yes, let me show you this website, which is called FINRA, which you may have heard of them. They are responsible for maintaining the integrity of the bond markets and other financial markets. We'll just randomly grab a few bonds and take a look at their features. So let's see. Now, this FINRA, I actually forget what it stands for, but they are one of the agencies that is designed to maintain the integrity of the financial markets, but particularly the bond markets. And so they, on their website, we can find prices for current bonds. I just find that this website is very poorly organized. I'm constantly trying to remember how to find what I need. Yeah, okay. It's really beyond belief to me how awkward this thing is. All right, bond prices, let's try that. Oh my God. No, you know what I find? The easiest way to do it is not directly from their website. Bond prices FINRA. Oh God, I hope they haven't changed this thing. Oh, wait a minute. The market data center. There it is. So here's all the bond quotes. Now, by the way, right here, this is the US Treasury market. You can see the yields go from 1 month to 30 years. These are the yields, and you can see this red line is what we call the yield curve. And that yield curve represents the yields of bonds of different maturities. And you notice it's downward sloping, which is very unusual. The blue is last year, and this is much more normal in US history. But you can see all of them are listed here. But right now we're interested in corporate bonds. So I'm going to look for search, Apple, let's say. And that should take care of it. It's going to offer me a look at all the bonds they've issued in recent years. So let's just pick one at the top here. I'll ask you for this one. Now, let's take a look at this bond. Now, the bond was originally issued in, last August. Okay, it's a very new bond. And it'll mature in the year 2029. So this, when it was issued, it had a maturity of 7 years. Okay. And the coupon rate is listed as 3.25%. Now that's locked into place when the bond is issued. But since that was issued, rates have continued to rise. So the actual market price of this bond is only 93.51 out of 100. Because rates have gone up in the economy so much, the bond has become less attractive than it was even just last summer. So the price continues to fall. And if you notice, the yield is not 3.25%, it's 4.412%. Now, why is that? Because if I buy this bond for 93.51, on the maturity date in 2029, I not only get to keep all these coupons, but I also get $100 back. Okay, because that's the face value. And that means I'm going to make a profit just from that part of it of $6.49. Okay, so that's a capital gain. And that plus the coupons will give me a yield or rate of return of approximately 4.412%. Now, that yield and that price are what can change in the market every single day. The coupon rate and the maturity date are locked into place. They will never change. So that means every year, I'm going to get a check from Apple for $3.25. That's my interest or coupon payment. But so anyway, if I buy the bond now and we have to pay $93.51, if I bought it last summer, I would have had to pay $100. And on the maturity date, whoever owns it will also get $100. So because the price of the bond goes down when interest rates go up, that means that when I buy bonds, I'm vulnerable to the risk that interest rates in the economy will go up. That's what I worry about. Okay, so this is not a good time to be buying bonds because pretty much interest rates are going to continue creeping up for a while at least. So we have to be careful when we distinguish between coupon rates and yields because they're two different things. So does that make sense to everyone? All right, so just keep in mind the coupon rate tells me how much interest I'm earning every year. That's a constant amount, it never changes. The yield tells me what my rate of return is given the amount I paid for this bond, which is in this case only 93.51. By the way, if rates have been dropping since the bond was issued, the price of the bond would have gone up and the yield would have gone down below 3.25%. Okay, so the bottom line with bonds is that interest rates or yields and bond prices go in opposite directions. Okay, when rates in the economy go up, bond prices go down and vice versa. So yeah, there's a lot of other useful information here as well, but that really was the bottom line. Okay, yeah, and you can see here, for example, they actually issued $1 million worth of this bond. And there's all kinds of other fun things here. For example, the payment frequency. The payment frequencies, by the way, are typically semi-annual in the United States. So in other words, this coupon would be split up into 2 equal pieces and set out every 6 months rather than once a year. Okay. So anyway, let's get back to this. And so we're making the assumption that interest rates in the economy are such that the 3-month rate is currently 2.5%, which, by the way, is an annualized rate. That means per year. All interest rates are quoted on an annual basis. So in other words, if I buy something, a bond with a 6-month yield of 3%, I'm actually only getting 1.5%, okay, because 3% is the annual amount. So if you look at this timeline, you can see that the market price of this bond is $1,020. The next coupon is due in 3 months. It's worth $50. And then in another year, in 15 months, I'm going to get the full face value of this bond plus one last coupon of $50. So those are the cash flows that I'm entitled to. Okay, $50 in 3 months, $1,050 in 15 months. The question is, what is this bond worth, and what is the forward price of the bond? In other words, if it needs to be delivered in the future through a contract, what would I expect to pay for it? So here is the formula. And basically what we're going to do is say, listen, that $50 coupon payment will not be received for another 3 months. So if you notice, we're using the continuously compounded formula to indicate that the present value of that coupon is $49.68.85. In other words, having $50 in 3 months is equivalent to having $49.6885 now. So that is the present value of that coupon, which the owner of the bond will receive, but not the owner of the forward contract. So we have to take that into account when we calculate the forward price of this bond. So you can see what we've done here is, here's the market price of the bond, which is our spot price. This is the present value of the next coupon. And then, of course, this 3 is the 6-month rate of interest. And then this 0.5 represents half a year because that is 6 months. So if you plug in all those numbers, what this is saying is that the forward price, the price that you would expect to pay for a 6-month delivery of the bond, is $984.9759. Now, this one, we don't use it as often because very few assets in the economy provide cash flows on a lump sum basis like this. Most of them, if they do provide some kind of an income, we can basically assume that the income is coming to us on a continuously compounded basis, specifically interest rates. Because as we saw before, interest rates are typically compounded on a daily basis, and mathematically, that means they're very close to continuously compounded rates. So when that happens, we're going to use this model to calculate a forward price, where you notice how instead of just R in the numerator, we have R minus Q. Q is the yield of that asset. So just a classic example of this would be if I want to buy British pounds through a forward contract, the price, I could write it like this. This is the US rate minus the British rate. Okay, that's what's going to go in the numerator, the difference between the two countries' interest rates. And that's how I found out or figure out how much I would expect to pay to take delivery of British pounds in the future. And again, that's because if I own British pounds, I would be able to earn the British rate of interest. Here, I'm not. So that reduces the value of the forward contract. So anyway, those are the three of the most common cases we might run into. Oh, here's a good example. So here we go. The spot exchange rate between the dollar and the pound is 180. The US risk-free rate of interest is 3%. The UK is 5%. What would be the price of a 6-month forward contract on the British pound? In other words, what would I have to pay for delivery of pounds in 6 months? So the US rate is 3%, the UK rate is 5%. It is a 6-month contract, which means half of a year. And we're assuming continuously compounded rates of interest for simplicity. And so if you plug in those numbers, you can see that the forward price is $1.78.2. So you can buy pounds now, $1.80 per pound. And the 6-month forward price is slightly lower, 178.2 per pound. So I can go to the market today and buy all the pounds I want for $1.80, or I can take delivery of them in 6 months for 178.2. And this is how I came up with that. And it really ultimately comes down to the relationship between the domestic rate of interest and the yield on this asset. Okay, where S is itself the British pound. Yes, Felicitas.
Is that how we had to calculate the forward exchange rate for the first exercise, for the first assignment?
Yes, this is the correct formula for that.
Okay, because I didn't do the parts of, I did like the 1.80, but like I didn't use the E or anything like that.
Oh, all right. Well, you know what? A lot of books do not use the continuously compounded interest rates. You can find, for example, let's say that instead you wanted to use, let's say, interest rates that are compounded every 6 months. What you could have done, you would put in the numerator of this expression 1 plus the US rate adjusted for the time and divided by 1 plus the UK rate adjusted for time, and you would have gotten the same thing, but the interest rates would have been quoted differently. Ultimately, it has to be this number. Okay, no matter how you get to that point, that would be the correct forward exchange rate for the British pound for delivery in 6 months.
Okay. But we didn't see this last class, right?
Oh, all right. Well, okay, well then I won't take any points off.
Thank you.
Now, this specific case with the exchange rate between the dollar and another foreign currency is referred to in finance as interest rate parity, but only when S is a foreign currency. In all the other cases, it's simply the forward price of the asset. Now, I've got a nice little table here that will summarize everything we just did. So in other words, the forward price of an asset depends on whether it pays no income at all, a known income, by which we mean bonds typically, and then a known yield, which is a continuously compounded rate of return. That's all we have. Okay, so those are the three cases. So when you figure out which one your asset has, then you can plug in the numbers and you've got your forward price. And by the way, the forward price can be either higher or lower than the spot price. It depends on the relationship, in the case of the pound at least, between the US and the foreign rate of interest. Okay, so F doesn't have to be above S, it can be lower as well. Now, by the way, we're going to fairly quickly discover what would happen in the market if we were given a quote which is not consistent with these formulas. Okay, but we'll have to save that for a little while. You might say, well, I mean, somebody could come along and offer us a quote which is different, but actually that turns out not to be the case. So we'll discuss that pretty soon. But right now, we're going to go ahead and revisit our friend futures contracts, where, we saw last week, they're very similar to forward contracts, but there's some very, very important differences. And both of these securities do trade side by side in the market, which indicates that they each have their own useful features. If one of them was clearly a better choice than the other, then the other one would just disappear from the market. People would stop buying them. And interestingly enough, a lot of derivative securities that are traded throughout the last several decades no longer exist, because either they proved not to be terribly useful, or something else came along that was more convenient, or maybe for some reason they became obsolete. But yes, a lot of derivatives have come and gone. And so the ones that are still around are the ones that have proved their usefulness to investors. And this is a classic example of that. Futures contracts have been around for centuries. In fact, I know I read somewhere that they were trading in Europe in the 19th century. Let me just see if we can find some details about this. Just out of curiosity. How long have futures contracts been available? Whoops. Oh, those are up. Why? You see, this is what I mean about Bing. It is so terrible. I did not ask it for options, and that's what it gave me. So we'll go to Google, a real search engine. Okay, so, well, okay. That maybe in the United States, it goes back only to the 19th century. I think it's older than that. The 19th century. Now, what's interesting about futures is that originally, oh, wait. 1730, the earliest recognized futures trading exchange is the Dojima Rice Exchange in Japan. Then your Cotton Exchange comes along. Chicago Board of Trade. In the early days, futures contracts were all agricultural contracts. They were designed to help farmers manage their price risk. And a lot of the trading took place in Chicago. A lot of the grains and livestock were traded in Chicago. And so the earliest futures exchanges all came into being in Chicago for that reason, because they were there to help the farmers reduce the risk that, they plant their crops in the spring, and before you know it, they're selling the crops in the fall and the prices changed. So these contracts were designed to help farmers manage their risk. Later, it was only later on, much later on, that the 1970s, as you can see here, that we started seeing futures contracts written on financial assets. Like, for example, currencies only really became available, currency futures, in the late 70s. And then they started introducing, futures on interest rates and stock indexes and, you name it. But it took a while for this market to really get going. And also, and gold and silver, of course. But yeah, still, I mean, so even though they've been around for a while, for the longest time, they were primarily agricultural contracts. So in other words, the financial futures that we see now are a relatively new innovation. Anyway, so what's different between the two? So forward contracts, as we saw last week, are negotiated directly between counterparties, which introduces credit risk. Okay, you don't have that problem with futures contracts. They're traded on organized exchanges like the Chicago Mercantile Exchange. So if you get a contract on the Chicago Mercantile Exchange, they will line you up with a counterparty behind the scenes. You'll never see any of this. You'll never be introduced to the counterparty. You won't know who they are, but they are out there somewhere. But if your counterparty defaults, it doesn't matter to you, because the exchange will guarantee the payments that you're supposed to receive. So no credit risk. Number two, well, all right, well, that's what this is. Number three, now this is an interesting outcome. A futures contract position can be offset by simply entering into the opposite futures position. So for example, let me sneak this in here. And this is not something you can normally do with a forward contract, by the way. So imagine an investor has a long futures position in a, let's say, March gold contract on the CME. Now, remember, long means that they're offering to buy gold through this contract. If the investor does not wish to actually buy the gold, he or she can offset this contract by entering into a short futures position in a March gold contract on the CME. The investor's position is then completely offset between the two contracts. And that means they have no exposure to the price of gold. In other words, it no longer matters what happens to gold. They have offset, they're out of this position. Even though they're technically in two different contracts, the two exactly offset each other. So no matter what happens to gold, it will not affect the investor's position. So what they're effectively doing here when they do this is they are taking their profits and leaving, if there are any. So there's no longer any obligation to buy the gold. With a forward contract, you're agreeing to buy gold from somebody, and when that day arrives, you better buy the gold, otherwise you're going to be in legal trouble. But here, if you didn't really need the gold after all, you can easily offset your position. Now that's a huge deal because a lot of hedgers are hedging their risk without really intending to buy or sell the gold. So what that means then is that most futures contracts do not result in actual delivery of the underlying asset. In fact, it only happens about 2% of the time because it's understood among hedgers with futures contracts that that's not the point of having a futures contract. Well, that's a good question. Yes, if your counterparty agrees to it, sure. If you call up your counterparty and say, listen, I don't really need this position any longer, can we cancel it? If they say yes, you're fine, no problem. But what if they say no? Then you have to go ahead and do whatever it is you promised to do. So it's risky. In other words, it's up to the counterparty to cancel a forward contract, whereas with a futures position, it is not a problem at all. Okay, so there's a risk involved with a forward contract. So usually what ends up happening is investors or hedgers who really mean to take delivery of the asset will probably use a forward contract. The futures contracts are typically used by hedgers who don't really mean to actually take or deliver the asset. All right, in other words, what they're saying is that we're hedging our position, but we don't really intend to take a position in the spot market. Like farmers. Yes, Felicitas, go ahead.
For the forward contracts, so how do you find another counterparty that?
Well, you go to a broker. Let's say I need a forward contract to buy British pounds in 6 months. I'll go to either a foreign exchange dealer. Let's say I'll go approach Citibank. Let's say I have a customer relationship with Citibank, and I say, listen, I know you're one of the major foreign exchange dealers. Can I enter into a forward contract? And since it's a commercial bank and an investment bank, and one of the world's largest foreign exchange dealers, and then they can make the arrangements with me. If not, I guess I can go to an investment bank like Goldman Sachs and just say, listen, I want to enter into this position, and you become one of their customers. But it shouldn't be too difficult to find an investment bank that will take the other side of your contract, because they do this all the time. So, but certain markets are more, like, for example, like I said, Citibank would be a good candidate for a foreign exchange forward contract because they happen to be one of the world's largest foreign exchange dealers. And it is also involved in forward contracts as well. So these are typically going to be, these counterparties typically going to be large commercial or investment banks.
Okay.
We're also probably dealing with whatever asset you're trying to buy or sell.
Thank
Yeah, so it's yeah, usually it's not individuals who are involved in this market. It's going to typically be large corporations who are trying to hedge their risks, or it could be financial institutions as well. But yeah, they would get in touch with each other. Oh no, there's going to be commissions typically, but they're probably going to be a fairly small percentage of the value of the contract. We can't avoid commissions altogether, but it's not going to be a huge percentage of the value of the contract. It's, it's kind of like almost like an insurance policy. There's a small price that you have to pay to hedge your risk. And so in the case of a forward contract, that would be the only real expense that you would have. Even with a futures contract where you have to put money in your margin account, that's still your money, unless you lose it all. At the end of the contract, if you have any left, they'll give it back to you. But now I don't know how much they charge. I believe that will depend on the size of the contract. Like a General Motors who needs to buy £1 million British pounds, the commission will be a relatively small percentage of the total. But a small business that only needs, let's say, £10,000, the commission will probably be a larger percentage of the total because, otherwise it's not worth their while to do this. All right, anyway, we could look this up. Let's see. Not with Bing, with Google. Let's see if we can find out. No, Google.com. What is a typical commit? Let's try this. What is a typical commission for a forward contract? And so, well, that's the futures. That's different. By the way, the futures markets are regulated by the CFTC, the Commodity Futures Trading Commission. It's equivalent to the SEC, but for futures contracts. Oh boy, I don't know if we should get involved with this. But, well, anyway, I don't know how much. Oh, look at this. These guys are offering to give you. Anyway, there has to be some expense involved. Otherwise, there's no point in the other side doing this. All right. Anyway. So what we want to do now. Like I said, because it's so easy to get out of a futures contract, the actual delivery rarely takes place because it's kind of a nuisance. You may just want to hedge away your risk without necessarily buying the gold or whatever it happens to be. Like, for example, if you already have enough gold, but you're worried that the price will go down, you can enter into a futures contract just to hedge your risk without necessarily wanting to buy or sell the gold. Whereas with a forward contract, because it's difficult to get out of it, most of the time the delivery actually does take place. And then with the forward contract, this is the marking to market part. With the forward contract, once you've locked in a price, no cash will change hands until the actual delivery date. So there's, you agree to buy gold in 6 months for $1,500 an ounce. And then in 6 months, you pay the $1,500 and you get your gold. Okay, but with the futures contract, we have this marking to market requirement. It's a type of collateral. We put money into a margin account, and the amount of money involved is usually quite small. I think we should be able to look it up somewhere. Let's see if I can quickly find what is the margin. Oh, for God's sakes, I have to go over to Google. This Bing is so terrible. All right, so what is the margin requirement for a gold contract on the CME, Chicago Mercantile Exchange. It should tell us. By the way, in recent years, there's been a trend towards offering smaller contracts to investors than the ones that were traditionally available, these so-called micro contracts. This micro contract is written on, let's see, how many, oh boy. Trying to find out how many ounces of gold this is written on. Specs, there it is, specifications. Okay, so this is only 10 ounces. Now, this is important because this is good for small businesses. The traditional gold futures contracts were written on 100 ounces. And if you couldn't afford this, well, then there was a problem. So according to this, the one contract is for 10 troy ounces. So if gold is selling for $1,500 an ounce, then this contract is written on $15,000 worth of gold. And the margin requirement is, oh boy, not listed here. Wow. Oh no, there it is. It would be right here. The margin is 700. It looks like it's $740 for this contract. So $15,000 is the amount of gold that you're controlling, but the margin account is only $740. It's not a big percentage, is it? But again, really, it's just collateral to make sure that you don't have a position that loses a lot of money and suddenly the exchange is on the hook for your losses. So they'll let you slide up to that first $740, and after that, you have to start putting more money into your account. So yes, so this is a fairly recent development, these micro contracts, because they're trying to attract smaller investors. Imagine you're just a small company, you're a small jewelry manufacturer, and you don't buy a lot of gold, not 100 ounces at a time. Instead, you only need 10. So therefore, you can turn to this micro futures contract and you can hedge your risk just like everybody else. So that's kind of nice to know that they're looking after the little guy. So by the way, this CME, I think I may have mentioned this once before. They make their money with volume. They're hoping that as many people as possible will be tempted to trade with them. So because they're hoping, if you go over here to the education link, you'll see they have all kinds of useful information, courses, lessons, all kinds of wonderful things that are available for free. Okay, and so it says here there's a course inventory, and so you can see all kinds of, and they're just sitting right there waiting for you to download them and read them. If you want to know anything there is to know about futures and options, this is the place to go. Okay. In fact, I think they may even have certificates you can get, but I don't really know that much about it, but they've always been willing to give you all this wonderful information for free because they're hoping that, of course, you'll turn around and become a customer. But just don't, just if you're really interested in learning more about the subject matter, here's one place you can go. And of course, these are the people who create these products. So they know what they're doing, right? So if they offer you a course, it's going to be good. Now look at some of these. CME Institute Financial Futures and Options Workshop. Wow, look at that. They really cover a lot of stuff. Man, and it's in foreign languages. Man. All right, anyway, so let's get back to this. And now, oh, God, yes, here we go. Where do we leave off? All right. And that's the market requirement. So the way it works is that you start out with a certain amount of money in your account, which is called the initial margin. That's how much you have to put in to start. And then every day, at the end of each trading day, they recalculate the position or how much it's worth. If you're losing money, the value of your the account declines, but only if it falls below a lower level called variation margin, would you have to put more margin back into your account? In other words, if your position loses $100, you may not have to cover it, but there comes a threshold after which you really will have to start putting more money into your account. And that's determined by the so-called variation margin. Now, I think I have a numerical example here somewhere. Yes, I do. Very good. So here is the British pound futures contract and the CME. And these are the terms and conditions. Now, if you notice, one contract is for 62,500 pounds. That's a lot of pounds. And this is one of the reasons, by the way, too, why it's so helpful that we can get out of this contract, because you may only want to hedge a much smaller amount of pounds, but this is all they have. So you can enter into one of these contracts with the understanding you can get out of it if you need to. And then also the delivery dates are only available for March, June, September, and December. So if you need to hedge an exposure that will take place, let's say in August, well, this is not perfect for you. You may have to choose between September and June. So again, it can be more difficult to hedge with a futures contract, whereas with a forward contract, you can customize it to exactly what you need. All right, let's see. The minimum price fluctuation is 0.0001, which means that unless the value of your position changes by at least 625, they will not bother to update the value of your position. Here we go. There's a numerical example of marking the market. So let's just say that an investor takes a long position in a September British pound futures contract, meaning that we're supposed to buy pounds in September, 62,500 pounds. The futures price is quoted as $1.26 a pound. Now, I'm going to multiply that out of my calculator. And that's $78,750. All right. So in other words, in principle, I should be prepared to pay $78,750 in exchange for 62,500 pounds in September. Now, let's just say the initial margin is $16.50, which is a very small percentage of the total. Let me just figure that out. Hold on. It's about 2%. Okay, so it's a very small amount of the total value of this contract. The maintenance is $1,000. So you initially put $1,650 into this account. If the value of your maintenance, your margin account ever falls below $1,000, you would receive what's called a margin call, and you'd have to not only put enough money in to bring you back to the maintenance of $1,000, but for the initial margin of $1,650. So, all right, let's see. Every time the price of the pound changes by a penny, that will affect the value of your position by $625. Now, the good news, though, is that if your position gains in value, you can take some of that money back as long as the balance in your account does not fall below $1,650. Okay, so it works both ways. You might have to put more in, but you might be able to take some out if things are going well. So yeah, here we go. So I put together this little chart, and you can see from day to day the futures price, and the first day it goes down. Now remember, we have the long position, and so that means when the price goes down, we lose money, right? If it goes up, we make money. So each day I've recalculated the margin value balance based on the fact that the position is for 62,500 pounds. So the value of the margin you can see on the right, and the maintenance margin is $1,000. So there's no margin calls until day 4, when the value of our position is only, I should say our margin account is $943.75. That's the first time that it ever fell below $1,000. So if you notice the margin call, is for 706.25 because we need the total to be restored to the initial balance of 1650. And then the next day we start to make money. So the margin balance is up to 2293.75. And now if I choose to do so, I can withdraw the difference. 2293.75 minus 1650. That means there's $643.75 that I could take out if I wanted to. All right. So the margin call just means we have to put money back in, but I also may withdraw the money if it's in excess of 1650. I may not want to, but I certainly can if I want to. Well, all right then. Now, you notice how at the end, we started out at 126. Our position declined to 125.9. Now, how much do we lose? That's even less than a penny. That's 0.01 cents. And so we lost $318.75. But we're able to buy those pounds for $1.26. So in other words, what happened here was that we're buying them for 126 when they're only worth 125.49. So the loss simply means we've overpaid slightly for those pounds, but we did lock in the price. So in a way, this contract is acting like an insurance policy, and this is the premium on that contract. So it's a small price to pay for getting rid of all that risk. I think you'll agree. And there was always a possibility that we could actually make money. If the price had gone up, we could have actually ended up making a profit from this while still locking in the price of $1.26. All right, now. So I think we're done here. Futures and spot prices. Now, what we're going to do here is introduce this very important idea of arbitrage. Oh, there is a committee at the exchange that takes care of this every day. We can look this up. Yeah, every single day at the end of trading, there's a committee whose job is to figure out what is the closing price for that particular asset so they can figure out how much your position is worth. Who decides the closing price of an asset at a futures exchange? I think I worded that very badly. Let's ask it specifically about the CME. Which group at the CME computes the settlement price of a futures contract? Okay, so the settlement is an official CME group price established for the instrument at a given point in the trading day. They determine the daily settlements for all contracts with volume or open interest. And wow, it doesn't look like there's a special group. I thought there was a group of specialists who took care of this. It says CME clearing. Wow, okay. All right, it's not as clear as I thought, but yes, the exchange, somebody working in this exchange has to sit there and look at market prices and figure out what is the settlement price for your asset. Like, let's say it's gold, and that way they can figure out how much your futures position is worth. And that's when they make their decisions also about whether or not there are any margin calls. So at the end of trading, which is 5 o'clock in Chicago, then they have to sit down and figure out what all the positions are worth. And so they establish what's called a settlement price, and that's the price that determines whether or not you have to put up more margin into your account. By the way, they're part of the reason that they're doing this in a particular way. They're trying to prevent traders from manipulating the system, and you know, they want to make sure the system is open and fair to everyone. So they sit down and they figure out what the price will be, so that it can't be manipulated. Okay. Oh, yes, arbitrage. Let me just briefly mention this before we go any further, because this is going to prove to be hugely important. This notion of arbitrage, we're going to see this all the time in the derivatives markets. What exactly is arbitrage? All right, so let's briefly introduce this. One of the more important concepts that we'll run into is this notion of arbitrage. An arbitrage opportunity or an arbitrage profit results when it is possible to simultaneously buy an underpriced asset and sell an overpriced asset. Now, the only way this can come about is if markets are inefficient, by the way. If markets are perfectly efficient, this is never going to happen. But let me show you a quick example of this. For example, suppose that gold sells for 1,500 in New York and 800 pounds in London, when the exchange rate is $2 per pound. So what this means is that the price in London, expressed in dollars, is 800 pounds times $2 per pound, which is $1,600. So you can see, now this is strange. The price of gold is different in New York and London. So because the gold is the same in every country, this means that gold is undervalued or underpriced in New York. And of course, that means it's overpriced in London. So what, you might say? So an investor could earn profits by buying gold in New York for 1,500 and then selling gold in London for 1,600, and then earning a risk-free profit of $100 per ounce by doing this. This is known as arbitrage. But arbitrage can only arise if markets are inefficient. In principle, this should never happen, but it does. Although in this day and age, I'll tell you where you really see this. Statistical arbitrage hedge funds do exist. And what do they do all day? Make their money by computers to analyze massive quantities of trading data and look for temporary discrepancies in prices between different markets. Now, these discrepancies may last for such short periods of time that no human being could execute trades fast enough to take advantage of these opportunities. So what do we do? So how do we make money then? The computers are programmed to execute the trades rather than human beings. Because computers, of course, are so fast. So in other words, computers are sitting there looking at all these different trades in the markets all throughout the world and looking at all these different assets. And they're saying, listen, are there any inconsistencies here, like the one I just showed you? And they have to grind through enormous quantities of data to do this in real time. And then if they spot a discrepancy, even if it only lasts for a fraction of a second, they may be fast enough to jump in and execute a trade, which gives them a profit. So now the only unfortunate thing about this is that, number one, markets are actually quite efficient. And number two, the profits from each of these trades are typically very small, so that the only way they can justify the cost of making the trades is to use huge amounts of borrowed money to finance the trades. Okay, in other words, I mean, imagine you find a trade where you're proud of yourself because you just made a penny by finding an arbitrage. Well, how does that help? Well, but if you use 100 million borrowed dollars to do this, then all of a sudden that penny might translate into $100,000. So the hedge funds are playing with house money, basically, or borrowed money. Oh God, yes, that's why some of these places disappear so quickly. How reliable? I guess that depends. We know that 1/3 of all hedge funds disappear every year. So that may be one of the reasons, because they screw up. Even computers can make mistakes, especially because the data itself isn't necessarily always 100% reliable, especially when you're looking at it over such short periods of time. Now, here's an interesting result, though. You might say to yourself, well, why don't we all sit there and just look for arbitrage opportunities? Well, number one, they're not going to happen very often. But number two, let's see what happens here. I just want to point out that if investors carry out this strategy, you can see what's going to happen. By buying gold in New York, the price of gold will rise in New York. The price of gold will fall in London. And guess what's going to happen? Eventually, the prices will be equal after enough trades take place. So in other words, this kind of thing is going to disappear very, very quickly. If it ever takes place in the first, if it ever happens at all, it's going to disappear very quickly, because the prices will adjust as more market activity. The buying of the gold in New York pushes the price up. The selling of it in London will push it down until the two will be equal again. So why do we worry about arbitrage then, if it's a very rare event in practice? And by the way, this is not free, this transaction here. If you're going to be buying and selling gold in New York and London, you're going to have to ship the gold across the ocean. There are transactions costs here too that could swallow up all your profits. So it's going to be very difficult to make money this way. But what this means, though, is that the prices of financial assets will rarely deviate. Well, actually, let's see. How do I put this? Oh, you know what? I just realized, sorry, my computer, it looks like I forgot to plug in my computer. I have to take care of that real fast. Hold on one second. But as I was starting to say, this is going to happen so infrequently. And, you know, it's not going to be very profitable when it does. But what will happen then is that there are certain relationships that will hold between financial securities prices that, if violated, will lead to arbitrage profits. And so in the derivatives markets, a lot of the pricing models that we use are prices that are based on the assumption that no arbitrage is possible. Okay, so in other words, in the derivatives markets in particular, this idea of arbitrage is very important, because we'll see that we can prove that if these formulas fail to hold in practice, arbitrage opportunities would arise. So even that futures, the forward contract price that I showed you earlier, we can prove that if that relationship fails to hold, that there would be arbitrage opportunities for investors. And so because of that, investors would jump in and exploit these differences and push the prices back to their correct levels. So derivatives prices are said to be arbitrage-free prices, which means that if derivatives prices deviate from these theoretical models, then investors could earn arbitrage profits, which would push the derivatives prices back to their theoretically correct values, I guess you could say. Okay. So anyway, we'll demonstrate this as we go along. For example, with a forward contract written on a foreign currency, there are steps you could take to earn profits if the forward exchange rate is different from that formula that I showed you. So if a dealer gives you a wrong quote, you could actually jump in and make arbitrage profits. Okay, so we'll do that throughout the course, depending on which market we're looking at. But a lot of this applies in particular to the options markets. A lot of the relationships that we'll see there will be enforced by this notion of no arbitrage. In other words, these relationships must hold, otherwise arbitrage will force them to hold. So oh, hold on, I have to plug this thing in. All right, so we'll see some examples of this. In fact, I think there's one coming up right now in the slides. Let's take a look at it. We're going to look at future and spot prices. So at any given time, the price of an asset that will be delivered through a futures contract is called the futures price. The spot price is the price for immediate delivery of the same asset. When the contract matures, the futures contract that is, the spot and the futures prices will equal each other. If not, there will be arbitrage opportunities, and that will force the prices back together again. For example, what if the futures price is too low? How could we exploit that? Well, now keep in mind that in this case, the futures price is too low, and that means the spot price is too high. That means we want to buy something with a futures contract and sell the spot asset and put the difference in our pockets. So here, for example, we enter into a futures contract to buy the asset for F dollars. We then use the contract to acquire the asset for F dollars. We then sell it in the market for the higher price of ST dollars, and the difference between the two is our profit. Now, of course, the important thing here is that as this happens, investors are buying the futures contract. The price of the futures contract will go up. Okay, so in other words, this activity will cause the futures price to go up. The spot asset, because everyone is selling it, will go down until the two are equal to each other, which is where they belong. Okay, so you can see if that relationship fails to hold, we'll buy the one that's undervalued, we'll sell the one that's overvalued, and put the difference in our pockets. And that is a risk-free profit. There's no risk. So other investors will do the same thing. Everyone will start buying the futures contract. Everyone will start selling the spot asset. And that will push F up, S will go down. And then at some point, all of this will stop when the two are once again equal to each other. So it's imagine like the hedge fund's computers finds this relationship being violated at 3 o'clock in the morning, and they jump in and they start buying the futures contract and selling the spot asset. Then the computers for all the other hedge funds do the same thing. And before you know it, the opportunity is gone. And this could be over just tiny fractions of a second because the computers are so fast. Yes, go ahead.
This will be done by getting into two different contracts, right? One to sell and one to buy.
No, just one contract to buy through the futures contract, and then you actually sell the the spot asset in the market. In other words, I buy the futures contract, I use it to take delivery of the asset, I pay F dollars for the asset, and then I turn around and sell it in the market for S dollars.
But you can sell it until you have the delivery of the asset, right?
That's right. That's right. That's correct. There could be a time lag, but if this is done correctly, we could earn a risk-free profit. Remember, this is assuming that the contract is just now expiring. So that means the delivery will take place pretty quickly.
Oh, okay, yes, because otherwise the spot price is gonna move and then.
That's right. That's right. So anyway, now obviously if S is too high, we're just going to work this backwards and we'll end up making a profit as well. We're going to sell the futures contract. We're going to buy the spot asset, use that to deliver through the futures contract and collect F dollars for it. So again, investors will start buying the spot asset, which puts up its price. They will sell the futures contract, which will push down the price, and the two will equal each other again very, very quickly, especially if, again, hedge fund computers are actually taking these trades. The opportunity will be disappearing in fractions of a second. But for a short period of time, they'll be able to make some money from this. So in principle, then, it means that it'll almost never be the case that these two will be different from each other. F and S will almost always be equal to each other, because if they don't, arbitrage will push the variables back to where they belong. So that's a case with the futures and spot prices. We'll run into this on a regular basis. Now, let's see. What we need to do now is consider, because forward and futures prices are, or forward and futures contracts have some different features, I should say. That implies that the price of an asset acquired through a forward contract and a futures contract could be slightly different from each other. Okay, ever so slightly. And this is not going to lead to an arbitrage opportunity, because really what's driving this is the marking to market feature. So forward and futures contracts are actually different enough that their prices can also be different without there being any arbitrage opportunities. So what we're going to consider is what could cause one to be higher than the other. What exactly is going on with that? And we'll see that it comes down to the marking to market procedure. So because this is kind of complicated, I think we've earned our break right about here, we'll knock it off for about 15 or 20 minutes. And when we recover, we'll come back here and look at what is it that exactly can cause a difference between forward and futures prices. Okay, so we'll come back in a bit and we'll carry on with this. All right, so see you in about 15 or 20 minutes. Oh, yes. The videos, like I was saying, I was having all kinds of issues. I was just on the phone with technical support before the class started, because I was unable to do what you said, get the video onto Brightspace. But now I believe I've taken care of the problem. So I will try to get last week's video and this week's video posted in Brightspace over the next day or two. I'm pretty sure I understand what the problem was now, but my intention is to make them available every single week so you can watch them at your leisure if you want to. All right. And then in the meantime, I'll continue to work on the camera issue, but the recordings are definitely available. It's just that I have to, or had a real technical issue where they were, what was happening was I was getting an email that said your recordings are available. And then when I clicked on the link, it would say, sorry, I can't open that link or some nonsense like that. So the problem is just about resolved. All right. So very soon, everything will be posted in Brightspace. Okay. Excellent. All right, here we go. I guess we can carry on now. So the relationship between forwards and futures prices. So let's wrap this up. So are they guaranteed to equal each other? No, they typically are somewhat different because of the market feature of futures contract, sorry. So how do we know which is which? So first of all, it comes down to what is the asset underlying these contracts. That really is what determines this relationship. So here's the way to think about it. Some assets, their value increases when interest rates go up. And in other cases, it's the other way around. So when the asset, let's say, for example, this is some asset that benefits from rising interest rates. If that's true, the futures price will be higher than the forward price, because then the marking-to-market feature is actually advantageous. Now, the reason for that is because when rates go up, there will be an increase in the margin account. And that means we can withdraw the extra funds and invest them at a high rate of interest. When rates go down, we lose money, but we can finance it at a very low rate of interest. So a positive correlation between the asset and interest rates is beneficial to the futures contract. It doesn't affect the forward contract, which means that if the correlation is negative, like with bonds, everything works in reverse. So for futures and forwards on bonds, then you would expect the opposite. Okay, so Bob, there's a lot of technical discussion here if you want to look at it, but this is the bottom line. When there's a positively correlated asset with interest rates, the futures price will be higher. And when the correlation is negative, it's the forward price that will be higher. Now, here we go. You can look at some hedging strategies with futures contracts. Now, forward contracts, since we can lock in any futures that we need, hedging with forward contracts is easy. Futures contracts are more challenging because, number one, they cannot be customized. Like we saw before, we have to only take what's available. So if, for example, we need a contract on British pounds on the CME, then we saw that the delivery dates that are available are only March, June, September, and December. And even then, it's only on one date within each of those months. It's typically the third Wednesday in each month. So if you need something else, well, you have to adjust your strategy to take into account the fact that this is all they have. This is what you take it or leave it. There's not that many different contracts to choose from. And of course, there's marking to market. So what do? Well, we know that this introduces some risk into our hedging strategies. So the best we can do, we cannot completely eliminate risk unless our position happens to perfectly line up with the available futures contracts. What we have to do instead is minimize the amount of risk that we're exposed to. So here's a perfect example. What if I'm an American company that does business in Iceland? Now, because the Icelandic krona is not a widely traded currency in world markets, there is no such contract in the futures, or there's no futures contract on the Icelandic krona. It doesn't exist. So what do we do now? Are we out of luck? Do we have to just simply not hedge our position at all? Well, here's what we can do as a compromise. Since Iceland primarily trades with the countries in the so-called Eurozone, which are the countries that use the euro as their common currency, why don't we try this? Instead of buying a futures contract on the Icelandic krona, which doesn't exist, we may be able to do a very good job hedging our risk by buying a futures contract on the euro. Okay, so because presumably if Iceland does most of its trading with the Eurozone countries, then the economy of Iceland should be highly correlated with the Eurozone countries. And so by using a euro contract, I should be able to manage my risk very well, although it won't be perfect. So that's one way in which I can still hedge in spite of the fact that the contract I need isn't actually available. And of course, if this still isn't good enough, I can just use a forward contract. Now, the delivery date. What happens if there isn't a delivery date that I need? Okay, so for example, we know that the British pound futures contract is available for delivery in March, June, September, and December. If I'm going to be exposed to risk in, let's say, August, I have to choose between the June and the September contract. It usually turns out that the best choice then is to take the delivery date that is later than the date on which you're hedging your risk. So in other words, with an August exposure, I'd be better off taking the September contract than the June contract, because then with the September contract, I don't ever have to actually take delivery of the British pounds. Whereas with the June contract, I would. So most of the time, if I have to choose a date that doesn't match up with my exposure, I'd be better off choosing the later date rather than the closer date. All right, now cross hedging. As we've already seen with Iceland, a cross hedge means you're hedging an asset with a different futures contract. And we can also use as another example the Swedish krona, because as we know, Sweden is not part of the Eurozone. They don't use the euro. If we hedge our position in Swedish kroner, then we could use a contract on the euro and create a position which does a good job of eliminating most of our risk. This is known, though, as a cross hedge because the asset that we're hedging is different than the futures contract. Now, how do you know which one to use? You'd want to pick a contract that is as closely related as possible to your particular situation. So here, for example, if my exposure is to the Swedish krona, I would probably use euros as my hedging instrument, not, for example, Japanese yen, because we know that the economies of Sweden and Europe should be very closely related to each other. Now that raises another question: how many contracts should I buy to hedge my position? Well, there's a couple of ways I can go about this. You can see the two titles here. The basic approach means it's kind of simplistic, but it can do a very good job. The minimum variance approach is a little bit more sophisticated, but it's also more complicated to implement it, as you can probably imagine. The basic approach just says, listen, the position you're hedging and the futures position should be of the same size, okay? So in other words, if you're hedging British pounds, and let's say your exposure is to 62,500,000 pounds, and each futures contract is on 62,500 pounds, then what you should do is buy 100 contracts. So that way your exposure and the number of contracts are both written on 62,500,000 pounds. You might think that's the perfect setup, but it doesn't necessarily work out that way. Now, here's another strategy which is based on statistics. This is sometimes called the minimum variance hedge ratio because it attempts to minimize the risk that remains when we hedge our position with a futures contract. So what are those symbols that you're seeing there? The sigmas, this is the Greek letter sigma, by the way. Those are standard deviations. And the standard deviation is a very commonly used measure of risk in the financial markets. For example, in modern portfolio theory, the risk of a stock is often measured with the standard deviation of its returns. So here, what you're seeing is that in the numerator of this formula is the standard deviation of the spot asset that we're hedging. In the denominator, it's the futures contract. This, by the way, is the Greek letter rho, and that represents the correlation between the spot asset and the futures contract that we're using to hedge our risk. So let's just take a look at a quick, simple example of this. So a US importer is buying 100 million Swedish kroner in 3 months. Let's say that we're importing Swedish jams. Now you may have heard of this lingonberry jam. It's a very popular type of jam in Sweden. And so an American company is buying lingonberry jam to sell in the US. And in order to do so, we need to buy 100,000 Swedish kroner in 3 months. So because we're buying the kroner, the contract that we will buy gives us the right to sell them in 3 months. So in other words, we need a short position. But since we don't have access to a futures contract on the kroner, we'll end up using instead a contract on 125,000 euros. So where did this come from? Why 125,000? Well, let's see. Let's assume that the standard deviation or volatility of the exchange rate between the dollar and the kroner is 20%. The futures contract is 15%, and the correlation between them is 0.82. So according to this formula, the ratio is 1.093, which means that we need for every unit of the asset we're hedging, we need a contract that covers 1.093 assets, units of that asset. Then, what we need to do now, the challenging part is figure out how many contracts that would translate to. So this is the number of contracts. This is the ratio we just calculated on the previous page, that 1.093. NA is the number of units of this spot position that we're hedging, or the size of the hedged position. And then finally, Q is actually is the size of one futures contract. How many units are there? All right, so this all looks very mysterious and all, but we'll see an example. It's really not that bad. Okay, so let's tie all this together with a numerical example. So remember, before we calculated our hedging ratio is 1.093 based on the standard deviations of the spot asset and the futures contract and the correlation between them. We are going to hedge the purchase of 100,000 kroner. So NA is 100 million rather. Each futures contract has 125,000 euros. So you throw all these together, and it turns out that ideally we hedge our position with 874 futures contracts on the euro. And that will keep our risk as low as possible, given that there isn't a contract for the Swedish krona. All right, now, I'll tell you what, why don't we jump ahead a little bit? I just want to show you what's coming up next time. And by the way, next week, we're going to be looking at swaps. After that, we're pretty much going to be spending most of the course on options because they're so complicated and they're so interesting and they're so powerful and they're so flexible, but we still need to understand the other basic types. A swap is basically an exchange of cash flows based on some underlying values. The most popular types of swaps are interest rate swaps and currency swaps. So what we're going to cover is the basic features, of course, of both of these swaps. We're going to understand how they're priced, how they're used for hedging purposes, and also take a look at some of the other types of swaps that trade in the marketplace. Now, swaps are sold in the over-the-counter market. These are not traded over exchanges, which means they can be perfectly customized to our needs. Okay, so just like forward contracts, These are 100% flexible. And so there's a lot of different kinds of swaps that we can create. What really separates swaps from forward contracts is that a forward contract it's basically a contract to buy or sell an asset at one point in the future, and that's it. A swap is designed to set up a situation where we can buy or sell an asset in the future at different points in the future. In other words, we might find that we need to buy something 5 times every year for the next 5 years or something like that. So a swap is different than a forward contract in the sense that it is going to be repeated periodically throughout the lifetime of the swap. So it's really useful for when we're hedging the risk of multiple exposures, not just one exposure. And I think I may have mentioned this to you. What's interesting is that the very first swap came about almost by accident. And we'll discuss this more next time, but if you look at Wikipedia, I think, or either that or Investopedia, they have a story about how this came about. It was between the IBM and the World Bank. So now this is very strange. The World Bank needed to raise German marks and Swiss francs to finance its operations. But for some oddball reason, Germany and Switzerland refused to let them borrow their currencies. Now, I have no idea what the problem was. I mean, the World Bank is an international organization that's designed to lend money to poor countries and help them get back on their feet. So I can't understand why this happened. But on the other hand, IBM, being a private company, had no trouble whatsoever borrowing these currencies. So what they agreed to do is, said the World Bank would have said to IBM, listen, IBM, could you please borrow Swiss francs and German marks and then trade them to us for some other asset that we can get our hands on? Let's see if we can. Oh, dollars. Okay. So in other words, it looks like IBM borrowed the Swiss francs and German marks, and they traded them to the World Bank in exchange for dollars. Okay. So in other words, what they're essentially doing is they're trading liabilities with each other is what they were basically doing. And in this case, it was because of restrictions that prevented the World Bank from borrowing the currency that they actually wanted. But you can see, as you'll see as we go along, that interest rate swaps and currency swaps are designed for the counterparties to take an existing liability and convert it into one that's more convenient. So let's say you currently find yourself owing money denominated in pounds, but you'd rather owe them in dollars. Well, you've got some kind of legal obligation there, but what you can do is trade your liability in one currency for a liability in another currency with a counterparty, and thereby either save yourself money or just for whatever reason, make your exposure more convenient. But it's a very powerful idea. And once this came to light and Wall Street in particular saw what happened, you can probably guess what happened next. A lot of these swaps were entered into because it became clear that this was an incredibly good idea. And so the volume of trading in swaps is absolutely now astronomical. So now later on, and this came much, much later, was this idea of credit swaps. They were designed to essentially enable investors to hedge their exposure not to interest rates or to currencies, but to credit risk. Unfortunately, with these products, well, let's just say there was a lot of problems that arose, and so that market came into disrepute. But it still exists, but a lot of losses were suffered during the credit crisis of 2008 and 9, and so they came to have a very bad reputation. But in principle, they could be potentially used by corporations and financial institutions to help reduce or at least manage their credit risk. So it's a very, very interesting idea, the swap. So we'll be looking at that next week. And then when that's over, we can dive into options, which are really by far the most exciting of all the derivative securities. Okay, so you'll see what I mean when we start looking at them. They're very flexible. They can be used to create a lot of different types of trading strategies. They're ideal for hedging. What really separates options from the rest is that you actually have to buy options. These other contracts are really just agreements. You're not really buying them. You're entering into an agreement. With an option, you're buying an actual security, and you'll pay the price whether you use them or not. Okay. So anyway, so I think now there is, I believe, a problem set for this week. Let's see what it looks like. Yes, it involves forward contracts, as you can see, and marking the market. It's not too long, but why don't you take a shot at that and send it in, by this time next week. And then next week we can pick it up here and dive into swaps, and we'll learn how they are structured and how we can calculate their value and understand all their key properties and look at all the different kinds of swaps that are trading out there. And then in the fourth week, we can really get deep into options. Okay, something to look forward to. All right, so in the meantime, I guess we can knock it off here, and I will make every effort to get the recordings up on Brightspace as soon as possible. And if there's nothing else, I guess I'll see you all next time.
Thank you.
Okay, good night, everyone.
you.
Okay, bye.
Thank you. Bye.
Can I just ask a quick question? I'm sorry.
Yes. Go ahead.
I was just wondering, what chapter should we be up to based on this assignment that you just gave us? Like, where should we be in the book right now?
Oh, okay. In Hull's book, let me see if I can go find the table of contents.
Because I think earlier she had a good point that what you showed us tonight, we didn't know to apply it to the one problem last week.
Oh, okay. Well, that's my fault. So
That's okay. That's all right. I just wanted to keep up with the reading.
Okay. Let's see what yes, I've forgotten the exact sequencing of the chapters, but he definitely, okay, let's see, look inside. These look insides don't always work for these classic books. Oh, for God's sake. I'll tell you what, I'm not actually at home right now. I do own a copy of Hull's book, but it's on my bookshelf at home. I will make a note to myself, and I will write back to you tomorrow and let you know what chapters these correspond to. Okay, I can't do it now because you can see it's not, it says look inside, but this is what they're giving you. Okay, so I'll get back to you tomorrow about that, okay? Or either that or Wednesday at the latest. But if you read through the chapters, you'll see that he starts out with forwards and futures, and then he moves up to swaps, and then at some point, the majority of the chapters after that are all about options. So depending which edition you have, I would say you could probably tell by looking at the titles which ones you're after. Actually, you know what? Let me just take a quick.
I do have the 10th edition. I think you recommended that one.
Yes, it's a very good one. Let me see if it's in the syllabus. If I actually put in the titles of the chapters, I may have. Where are we? Oh, you know what? This is interesting. I somehow got my hands on a PDF version here. I didn't remember that. All right, I'll tell you what. Let's look at this. Oh, here we go. So if 10 is similar enough to 9, it looks like mechanics of futures markets is 2, hedging strategies of futures is 3. Then you could skip over 4 if you want to. 5 is determination of forwards and futures. That's pretty much where we are now, 5 and 6. as you can see here, if your titles are similar to these, we're pretty much up to 6 right now. And then swaps would be 7. That'll be next week's chapter. And then after that, what you would want to do is start mechanics of options markets would be the week after. And so that would be roughly chapters 10 and 11 for week 4. And then we'll get involved with the trading strategies. We'll look at binomial trees, which are for pricing purposes, and then the Black-Scholes model. So for right now, what we're covering basically covers what Hull did in chapter 2 and 3, 5 and 6. And then following next week, we'll be doing the equivalent of 7. Probably the 10th edition is identical to this. He probably added a few chapters towards the end. I don't doubt that he changed the order. And then, yeah, like here, for example, he added here a lot of discussion about credit risk and credit derivatives, which wasn't there before. Value at risk, we'll save that for the end of the course. We'll be following these chapters later on. But so, yeah, that's what I would say.
Okay, all right, that's fine.
Okay, great.
All right, yeah, thank you.
Okay, bye.
Have a good night.
You too.